The IRS officially kicked off the tax season on January 27th, and there's the Trump administration. They're going through a lot of in pending changes. A lot of tax laws is going to be changed. I'm going to skip over some of this. Let's not talk about contribution, IRA contribution. You know what you got to do. Go work with your financial advisor, contribute consistently to your IRA accounts, whatever. Let me fast forward to but there's a lot of changes in the tax law, and the IRS themselves, they have a hiring freeze on our new IRS agents. And it's just government is chaotic. By being in the army, I'm part of the government, and I see some disturbing trends that's going on. I'm not going to be too political with Mr. Musk and Mr. Trump, how they are impacting what's going on. But let's continue. We're going to go over the tax return momentarily. And if you own it, let's be real quick. There are two tax forms that you need to understand fully, whatever strategies I'm teaching you tonight. Schedule E, I don't know how experienced you are, whether you're a rookie, whether you own 2 rentals. Look, if you own 2 or 3 rentals, don't be so arrogant. To me, you still a rookie. You still know almost nothing, especially tax strategies. When I consult with an investor and I'm going to go over the tax returns, they have no clue. They've been investing for 5 or 10 years. They have no clue how to maximize their tax savings. When I ask them why you're not maximizing your tax savings from your real estate portfolio, they say, well, I don't know. I try to do it myself. I try to learn everything on my own. I never hire a professional advisor. Why not? Why not spend several $1,000s to hire a real CPA who understands tax laws for real estate investors? You need to learn to delegate. You need to learn how to leverage the professional expertise, someone who understands real estate, whether they're attorneys, whether they're CPAs or tax advisors. Pay them whatever they ask for. Several $1,000s doesn't matter, because if your tax situation is very complicated, you need to find yourself a team of advisors that can help you over time. Because if you're penny wise, you could be a pound foolish. You're not willing to pay several $1,000s to do tax planning. What if you potentially lose tens of $1,000s by not getting a proper tax advice? I see this happen way too often. Some people have this, they think they know it all, very arrogant investor. They think they can do everything themselves, fix their own property, make their own decisions, and they don't trust a team of financial professionals. You know how often I see those idiot moron investors that think they know it all? They're going to get burnt if they don't work as a team. Schedule E is a real rental tax schedule. Schedule C is a sole proprietor. You can be a sole proprietor, Schedule C, profit and loss statement, and become a real estate investor. Similarly, Schedule E, which is a supplemental rental supplemental schedule. Schedule E is the primary tax form to document each of your rental properties. Here's the Schedule E right here. It's very simple. You just Google IRS, get on the website, and Google Schedule E, and you see the form. You see the rent received on an annual basis right here, then all the expenses. It's simple. It's like a profit and loss. The rental income you make minus all the deductible expenses, normal, conventional deductions, and then you add on depreciation, which is so amazing. And we can talk about that. All right. So the key for you is make tons of money because you're collecting such a high cash flow, such a high rent, and then this gross rent that you receive, believe it or not, this gross rent that you receive before deductions is subject to ordinary tax bracket. If you are in a 37% tax bracket, which is making like 400 grand per year, you're subject to pay 37% federal rate on this gross rent if you don't know how to do the deductions. So the key is you need to reduce your gross rent you collect from your rental subject to ordinary taxation at your marginal tax bracket. So therefore, you are afforded. You need to spend some time with your advisor to look at all the deductions. Any kind of deductions will reduce your rent subject to ordinary taxation. The more deduction you can claim legally and ethically, the better. And the best deduction of them all is the phantom write-off, the depreciation paper write-offs. So there's a lot of limitations. We could go over that tonight. But at the end of the day, you're receiving positive cash flow. A whole positive cash flow. Unless you buy properties in California, you're not going to cash flow because the price is too high and the rent is too low. That's the bottom line. That's why I like investing out of state. You buy a very affordable property in a very good growth market. Make sure the rent you collect will cover all your debt service, all your expenses, and then you have positive cash flow. Even though your tax return show on paper you have negative loss, paper loss. That's the key. The paper loss you achieve if your deductions and your depreciation on paper on the tax return Schedule E for the most part is higher than your gross rent. That's a good sign. You have passive losses. Does that make sense? So even though you're making real money, you are truly getting passive cash flow into your pocket every month. You're making money. You're generating income in addition to appreciation and the whole 9 yards. But on paper, you have a paper loss, and that paper loss can offset against your paper gain. So the IRS, the way they define the traditional way, the traditional way to define real estate in terms of the IRS definition is such that your passive losses can only offset to the maximum extent of your passive income. The IRS definition, the tax code determine any kind of passive losses means all your expenses, regular expenses, taxes, insurance, property management fee, maintenance, upkeep, and your depreciation. Those are passive losses on paper. And the total of your passive losses cannot exceed your passive income. Passive income is all your rent that you collect. So the IRS, the legal definition of a rental property is a passive activity. Even though you may be actively involved in the management of your property, where you do the repair of your rental property, you're actively involved in your property. Tax law definition of a rental property is such that it's a passive activity. Since rental properties is a passive activities according to the laws of the IRS tax code, you cannot write off all the passive losses, including depreciation, only to offset against the maximum of your passive income, which is your gross rent. Anything excess above and beyond the passive income from your passive losses is suspended indefinitely to the future years to offset against other passive income. What are the other passive income? The other passive income most of the time are your other rentals. If you are receiving other rental passive cash flow from your other rental properties, then the suspension of the passive losses can offset the future passive income from your other passive activities from your portfolio. Does that make sense? So just because the traditional rule, other than the creative strategies I'm going to teach you later on tonight, that can overcome any. Again, the key is passive losses can only be reduced to the maximum passive income. And if you passive losses exceed the passive income, the losses that will carry forward into the subsequent tax years to offset against passive income from your other passive activities. Does it make sense? For years and years to come, the ideal world is to get as much as current deductions, maximize the current deduction in the current tax year as much as possible, instead of allow the losses to suspend indefinitely to the future years. You want today's dollar to be affected by taxes to your benefit. You want more deductions as soon as possible because inflation will kill your money. So the future money, you lose value. You don't want to delay the tax deductions suspended into the future years. You want as much current deductions as possible to affect your current year because the value of the dollar and the inflation will kill you. Understand? You understand the time value of money? The future dollar would decrease in value due to inflation and the purchasing power. You want to have as much deduction as possible as at the earliest point possible. Understand? Of course, you can put your questions on a chat below to address any clarification you might want.